Crossing the Line, where we dig into the latest news on the economy, housing, and whatever else is on our mind. Today we return from what was hopefully a well-deserved 2 weeks off. Everybody have a good holiday? How was the holiday?
Great. How was yours?
Except for that lump of coal in my stocking. It was outstanding.
I'm
There's
so
no sound
sorry.
effect? I
mean, listen, I was going to let you, share your grievances, but Santa can't be great to everyone,
No. What about you, Ray?
Pretty good.
Good holiday. Lena?
Fine.
Did you make lasagna again, or? All right. Well, again, maybe one of these days we'll get it. I guess not. Today is January 8th, and this is our 8th episode.
It is.
That's coincidence. Go bet that number, my mother would say. And it's our first of the year, and we're really glad to be back. And a special welcome to any new listeners out there. Make sure to subscribe to this and all the other great podcasts on the More Network. And as always, thanks to our returning listeners.
Yes.
We've done pretty well, and we appreciate the support. I'm Greg Heym, chief economist at Brown Harris Stevens and author of The Line, the blog, which serves as the show prep for this podcast. And again, we have Hannah, as always, to keep me in line, and Ray and Lena making sure I look good. That's a full-time job in and of itself, but we'll...
Thank you to them.
Yes, I'll take all the help I can get because, I need it. As always, we're coming to you from our home at Studio 1873, conveniently located right outside my office. Our goal is always to be informative, concise, entertaining, and edgy all at the same time. And just a reminder, if you'd like to send us any questions or comments or any kind of feedback, ctl@bhsusa.com. So let's start with our line items, because everything on the show is branded with the word line in it. That's really cool.
It's catchy, it's quirky, it's a brand.
Well, we like a certain amount of consistency, like we always have Ron Guidry here.
Yes, we do.
And behind me, we always have Alfred E. Newman, just to show you that we all are subject to criticism. And the 80 Olympic hockey team. And by the way, congratulations to the U.S. national junior team, which won the world championship against Sweden in Sweden.
Wow.
You know what? I think like a lot of the better Canadian 18-year-olds go play pro hockey right away, but we'll take it. It doesn't matter. Congratulations, Team USA.
Yes. One more applause for that.
USA.
Yes.
USA winning hockey championships was an unknown thing when I was a kid until this happened, and it's good to see that the program has just gotten better and better. So really our big line item and the big economic news story last week was the jobs report for December. Payroll's up 216,000. That easily beat the Dow Jones estimate of 170,000. Right away you get concerned because we don't want to see any signs that the economy is running hotter than expected, because that puts this great decline in mortgage rates in jeopardy. It's funny though, because since we finished the year and we came in above expectations, the question I asked myself was, how often did economists get it wrong? Because they're economists. So in 8 of the 12 months last year, their forecast was below the original figure. Some of the figures were revised, and the economists would say, well, then we look better. But it just shows you they tend to be a pessimistic bunch. Not me, though.
Never.
I'm absolutely optimistic that I'm pessimistic.
You're a shining beacon of optimism.
Well, that's a lot of pressure to put on me, but that's what people go to, Lena. They go to their economists for help and to be uplifted. And all right, I got to stop because I'm not even believing that. So the number was better than expected, and here are the other key takeaways. For all of last year, employment rose by 2.7 million. That's down big time from the previous 2 years, but it's still way higher than before the pandemic. Right. So like a lot of things, it's not 21 and 22 anymore, but it's better than 18 and 19. So that's good. The unemployment rate held steady at 3.7%. Economists were expecting to tick up a bit, so that's good. Wages rose 0.4% in December and were up 4.1% from a year ago. That's a little concerning. First of all, both those numbers were higher than expected. And remember, as we've said before, what's happening with wages is very important because money in people's pockets means they can spend it.
Correct.
And that 4.1% increase in prices is about 1% higher over the last year than wages. So wages are growing about 1% higher than prices. That, is good in the short term because it increases our purchasing power. We can buy more stuff, but that's not going to help in the fight to get inflation under control. The biggest contributor to job growth last week was, that's correct, government. Good job. Anytime government's the leading adder of jobs, you have to be a little concerned because it's really private sector employment we're looking for. If you're looking for bad news in the report, the labor force participation rate, which is not only hard to say, but it basically is the percentage of working age people that are either working or looking for work. Obviously, with a lot of jobs still going unfilled, we'd like that participation rate to go higher. It's kind of held within a range, but it did go down, as did average weekly hours. We talk about wages. We're talking about hourly wages. The other side of that equation is how many hours they're working. So when we see decline in hours, that's a concern. The stock market wasn't very happy last week. This didn't help, and it snapped its 9-week winning streak. So we had a great 9-week run. Let's start a brand new week of stock gains this week.
Let's do it.
Yeah, that'd be nice. We like to be winning, as Charlie Sheen would say. If he were
As
here.
he said like a decade ago.
Has anybody seen Charlie Sheen in the last 5 years or so?
I don't think his family has either, I think. But
I don't think
like,
they want to, but guy was
Really?
always. He was what?
He's back on. He's doing well.
Oh, good for Charlie. He was very funny.
I always loved him.
I just recently started watching 2.5 Men, and it was really funny. In other labor market news, we found out that there are still 8.8 million jobs out there, which is actually down from the prior week by 62,000, but it's still a remarkably high number. It actually equates to 1.4 available jobs for everybody looking for one. So that's still, there's a good and a bad side. It's good for the people looking for jobs, but it shows us that our economy could be going a little stronger if we could fill these jobs. But again, that wouldn't be good in the fight against inflation. So just goes to show you, we always have to ruin it as economists, take good news and turn it into bad news. Weekly jobless claims fell by 18,000 to 202,000. That's an incredibly low number. Again, you've probably seen headlines, layoffs doubled in 2023. Everybody's laying everybody off. But as we talked about this, I think in one of the early shows, that announced layoffs don't always materialize, and they sometimes get offset by hiring in other aspects of not only that company, but the industry or other industries.
True.
So with so many available jobs out there, it shouldn't be all that surprising that people are finding jobs quickly and not filing for unemployment. So that's good. So what does this all mean, Hannah? Well, if you were expecting and hoping and wishing and praying, like Dusty Springfield, did I get that right in the right order? I don't remember.
Who's to say?
If you were betting on rate cuts starting in March, you're not getting them. And I don't know why anybody thought that. In the first place, markets were really pushing for that. You can forget about that now. Things would have to change. And another thing to remember is that the Fed decisions are very data dependent. They reserve the right to change their mind at any time based on any data that comes out. The bottom line is job growth is strong. Wages are rising faster than prices. And inflation is still above the Fed's target of 2%. So it has been some concerning news. The manufacturing sector of our economy contracted for the 14th straight month in a row. Obviously, manufacturing is not a huge part of the economy, but you combine that with the services. There's this Institute for Supply Management that puts out the ISM indexes for manufacturing and services each month. And again, manufacturing's been contracting. Service industry is still growing, but the growth rate slowed last month. So, it depends how you look. You look at certain data points like that, economy looks like it's cooling. Then you look at hiring and it's like, wow, it's gangbusters. So for now, we're just all going to have to enjoy the fact that companies are still hiring at a brisk pace, unemployment is low, but don't expect any rate cuts. I would say not, at least until the second half of this year. So speaking of rates, and I didn't have any good titles for articles this week.
Yeah, but sometimes I like when they're concise and to the point.
Well, we try to get to the point. But this one was mortgage rates tick up, but that's not the real story.
So what is the real story?
Well, the real story, well, thank you. We've been away for a couple of weeks, in eating, drinking, and being merry and, spending time with family and working still. But during that time, mortgage rates had mostly continued to fall. It ticked up by almost a negligible number last week, so it's not a big deal. But the big story here is what's happened over the last 2.5 months, and that's mortgage rates have declined after hitting a 23-year high of just under 7.8%. The week ending October 26th, rates are down 1.17%. That's real progress. Are they down to where we'd like them to be? Of course not. We know not to expect 3% mortgage rates for a very long time. But we can get excited about how the purchasing power of home buyers out there has increased pretty dramatically in just a span of a couple of months. And economists, and not just me, although I am one of them, are looking for lower rates this year. Even floating the idea of rates getting below 6% by year's end. And I agree rates are headed lower, and I think they're going to definitely get below 6%. If we can shave over 1% off in 2.5 months, we can definitely. We're sitting at 6.62 now. You shave another percent off, that maybe we won't do it in 2.5 months, but I think in 6 months we could do that and get below 6. So I think we're moving in the right direction. And again, for some perspective, the average 30-year conforming mortgage rate over the last half century is about 7.8%. So, remember that people say we can't, we talked the last show with Vince about how the math of home buying doesn't work anymore. Well, this is how that changes and how it changes very quickly. So that were the line items. Mm-hmm. That was the line items. You're supposed to edit this stuff.
Well, here's the thing, okay? Something inside hurt when you said that, just being the editor that I am. But
remind me why we filmed these on Monday morning. Remind me. Oh, wait, that was my choice.
Yeah, you got to start the week off strong, and you did just now. And the year at that. So now we have the lineup. But speaking of holiday celebrations, a lot of that included spending, which jumped nearly 5% to record.
Yeah, Adobe. I thought Adobe just for the PDF people, but no, they measure this stuff. So they actually, in November and December, online holiday spending rose to a record $222.1 billion. It's funny.
That's crazy.
Because how much did you read about how no one was going to be able to spend this year? It's fun. Every time we count the American consumer out, they just give us a big middle finger and say, well, we're spending. Well, what are you being so negative for? It's amazing. Now, a couple things to understand about this is one thing that was interesting is it was about people buying more stuff, not higher prices. So prices were discounted.
Yes.
But guess what? In this country, in every country, that's how you sell things.
I also thought it was interesting that shoppers are leaning on the buy now, pay later installments.
Because it sounds like a great idea.
It does. There's like Afterpay and Klarna. There's another company. A lot of people do this now.
It's weird because I'll be on Amazon or something buying like a $20 item, and it'll say if I could pay 4 monthly payments of $5.
Sounds good to me.
So we know that credit card debt is enormous, over $1 trillion in this country, and the rates are very high. So I think people are looking for more affordable alternatives than just the old-fashioned charge it thing. One thing also to remember is this doesn't account for what people spend in stores.
Right. I'd like to know that number too, though. That'd be interesting.
Well, people forget it's still the bulk of the purchases that people make. Everybody thinks online is like 99% of shopping, but that's only among Gen Zers. There are older people that enjoy. I'm not one of them, but there are older people that enjoy. Like anytime my mother needs something, I need new sheets for the bed. I'm like, all right, we'll just go online and get it. No, why don't we go to Macy's? Maybe they're having a sale. I'm
Yeah,
like,
I mean, it's nice to make a
and
day out
Alina's
of it.
like, what? Macy's, what's that?
I'll in-person shop within reason. I avoid Friday nights, the weekends, anywhere.
And that beautiful mall of yours at the Meadowlands. The American Dream is just...
The Freehold Mall in Freehold, New Jersey is my mall.
Was that Springsteen's favorite mall growing up?
Most likely.
Of course.
I don't think it was around yet.
Oh, okay. I was going to say, well, everybody knows that. All right. So what do we got next in the lineup? What's batting second?
This is an interesting one, I thought. Data quality is getting worse with falling response rates
So this is
in
near,
surveys.
This is near and dear to my heart.
Right.
Not just as an economist, but I'll tell you more later. So the bottom line is that, you know, the numbers that we just talked about and that we talk about every week and that moves markets and that Wall Street foams at the mouth for those 8:30 release times or whatever time the stuff comes out, relies on these surveys that are sent out. And the interesting thing is, and the article points this out, that the government's really the only organization of any kind that still phones random people, you know, when it conducts surveys. They're done
Like
a lot.
cold calling.
Right. They're done a lot smarter by private sector companies. And, you know, again, we're talking about data about employment, prices, spending, things like that. And the response rates, which for a lot of these surveys used to be like 90%, have plummeted
Right. No one answers the phone.
way below the 80% or so threshold that they would look for. And that can affect data quality or at a minimum cause inconsistencies. We talked about employment rising by 216,000. That's what's known as the payroll survey. That's when they send out, you know, the requests from companies about how many people are on their payrolls. But the unemployment rate is calculated using the household survey, which is that random calling of people and asking them if they're working or they're looking for work. So, and that's a much smaller sample. So you really need a decent response rate. And what happened is if you look at the employment, the total employment by using the household survey responses, they have it declining by 683,000. So that's a big difference in increasing by over 200,000, right? So, you know, those data points always have discrepancy issues because they're two separate surveys, but you wonder if the reduction in the response to the household survey is having something to do with the problem because it's a sample. We're not going to ask every American if he or she is working. You know,
Right.
you pick a sample and then you sampling. Economists do that all the time. And you know, this goes to the other reason this is near and dear to my heart is my first job out of college was as a field economist for the Bureau of Labor Statistics.
Right.
And one of the things you do is you call up companies and collect wage and benefit data. That was the division I was in. If they don't respond, you may mail them something. If they still don't respond, then a lot of times you would just pop in on them, which they loved.
I'm sure they did.
So, you know, you have these refusal rates and not a surprise that New York would have the highest refusal rates in the country. And then, of course, Washington would think they could do better and they would be like, we're going to call these guys and harass them. I mean, there's nothing like knocking on a business's door and say, hey, I'm with the Department of Labor. I mean, it's just the only thing worse would be if I said I was from the Treasury Department. Like that might get me in more trouble.
Right.
So I think this is an issue. Hopefully the BLS and Census Bureau and all the other important data gathering organizations, the federal government, are all over this and thinking about this because data can be volatile to begin with, but we need to know that it's reliable and being based on a big enough survey. So I think, you know, it's something to just keep in mind and watch, but as a former field economist, it hurts me deep down.
I'm sure.
It was a fun job to have. I get to go to exotic places like upstate New York.
Wow.
In the winter.
Really up there.
And conferences. We went to an annual conference in February in Minneapolis one time. It was just beautiful.
Yeah, no, we need a wind sound effect for that one.
Or a chattering teeth sound.
Yeah.
All right, so I think we have one more.
Yes, we do. This headline was particularly interesting. Welcome to the neighborhood. Wall Street designed it.
See, I wish I'd have come up with it.
Right? I thought that was really catchy. So this was a story that talked about big investors who are basically building their own
Right. It's why,
properties.
as we know, big investors, also known as Wall Street and hedge funds like Blackstone,
Right.
in particular, have been buying up a ton of single-family homes across the United States and renting them out. But much like us common folk, they are not finding enough homes to buy. So they've come up, like Wall Street does, improvise, adapt, overcome. They're like, well, let's just create towns with houses, and then we own those houses. And that's kind of exactly what they're doing. They're building these neighborhoods that are 100% renters, and they own the homes. And I think we need to expect more of this. Look, we've said before, and everybody's saying, we don't have enough single-family homes out there for demand. That's why even when rates hit a 23-year high, home prices across the country weren't coming down because there weren't enough homes to go around. So prices just kept going up. So we're all for new homes. That's a great idea. But I don't know. How do you feel about the fact that you may be competing against Wall Street one day to buy a home?
Well, I mean, I'm strong. I can really rally. So we're gonna have to see. They're gonna have to put up with me. I'm feeling good. That's my answer.
Good luck, Wall Street, on that one. That's gonna be a tough fight. These Jersey girls.
We're tough.
And the hockey fans too. They'll elbow you. It's tough. And this is interesting. There wasn't any data sourced here, but the article mentioned that people that are renting, and this makes sense, that people are renting in single-family homes stay longer than those renting apartments. A lot of times they have school-age children. They want to stay in there till the kids go to the next school, whatever.
Right.
So they typically stay over 4 years, whereas in your regular apartment building, it's 2 to 3 years. So it's a good investment for them. Wall Street's always looking for new ways to make money. And when you have a tenant base that's going to stick around and you can build your own town, sure. Now, if you were going to do this, what would you name your town?
Can't put me on the spot like that. I mean,
Of course I can. It's my show. I'm crossing the line.
Gregville.
Gregville. What was that in the Superman movie, Otisburg?
Listen, as long as there's a Target, I'm good. In Gregville. Would there be a Target in Gregville?
I don't know. I think Hannahland would work okay.
That just sounds like an oasis. That doesn't sound very serious. That just sounds like a vacation.
Like up there with Dollywood, is that something like that?
Yeah. Yeah. Yeah.
Well, there's enough of those going around.
Yeah.
It's an interesting concept, and housing it was a good year for new home sales because there were no existing homes to buy, and hopefully now that the spread between the mortgage people have and the mortgage they would get if they bought a new home, if that continues to narrow, then we'll get more product out there if people decide finally to trade up or trade down, and that would be good news. So I guess that's a hope we take out of this. But this is sort of an interesting concept,
right?
That a lot of us didn't see coming, and I know people be worried it's another thing Wall Street's trying to take over, but they're about making money, and
they are.
And we'll get some new towns and some new houses,
interesting towns
that apparently
like
all built exactly the. What would be wrong with Gregville?
There's nothing wrong with Gregville.
I don't know if I like Gregville.
It kind of has a nice ring to it.
All right, we'll see. Send in your suggestions to CTL
yes.
at bhsusa.com. Ray, what are you calling your town?
No comment.
No comment. I could see that.
That's an interesting name.
No comment, like Wisconsin. That's where Ray's going to live.
No comment, Wisconsin.
Well, it's
population 2.
Population, yeah.
Me, myself, and I.
Yeah.
He just wants to be, left alone, I guess. Much like Ronnie Van Zant in Tuesday's Gone. Anyhow, all right, well, that's it for this week. We tried to make a concerted effort to get, I know we said this in the first episode and then completely ignored it the following 6 episodes because we were having so much fun, but we are going to do our very best to keep these under a half an hour.
Short and sweet.
So people,
and informative.
Yeah, we don't want you listening to the show to seem like a several hour commitment. So we're coming in at right about 25 and a half minutes. So
yes,
that's really
and be
good.
sure to like and subscribe to the More Network.
Yes, and
for many more incredible podcast episodes.
They're a great podcast. We've been doing some shameless cross promotion. You know, we had Vince, then I did Vince's podcast the next day, and that's going to continue. But they're actually really good, and they're all very different. So
yes, absolutely.
You're not going to be hearing the same old stuff, and they're not just, hey, buy real estate because it's awesome podcasts. They're real issues and really well done here in Studio 1873. That's it. You can applaud yourself, Ray. That is fine. Well, thanks again, everybody, for crossing the line with us, and we'll see you, or you'll hear us, next week. Thanks again.